How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about loan loss provisions. So there was a couple interesting new data points that popped up here in the first quarter. So I wanted to look at, are banks holding enough money in loan loss provisions to cover loans that basically could go delinquent? For those that don't know, basically every bank is required to hold some amount of money in what's called a loan loss provision. That is to protect the bank in the event that basically they have loans that go bad. So if you have a loan that goes bad, you have to basically reserve money for it. Banks have, historically used a couple different systems for this. More recently, banks across the country are using something known as CECL, which is an acronym for the current expected credit loss. And there's a whole methodology to that. I'm actually working on doing a whole episode on CECL, but we'll put that aside for just a second. So I just want to go in here. So a couple articles that came in here in the last week or so. So this one was called "Fed Urging Banks to Increase Loan Loss Provisions, Test the Discount Window." So the Federal Reserve is proactively working with banks to bolster their resilience in preparation for unexpected shocks to the financial system. While U.S. bank financial health is generally sound, the Fed is encouraging banks to implement risk management strategies as it monitors potential vulnerability in the financial system. This includes stress in commercial real estate and the rapid growth of private debt. In other words, what you call like buy now, pay later. Fed Governor Lisa Cook said during a recent presentation at the Brookings Institute, the key is to check the shock absorbers on the car and make sure that it can make the drive. And then it says here, basically, the Fed is specifically pushing banks to increase their loan loss provisions. U.S. bank credit provisions rose sharply in 2023 as banks predicted continued credit normalization and elevated risk. Still, many banks reported lower than expected provisions in the first quarter. Having proper provisions is particularly important for banks with high CRE concentrations, as work from home trends and reduced office usage have led to pressure in bank CRE portfolios in the wake of the pandemic. Additionally, the Fed is encouraging banks to pre-position collateral at the Fed discount window so they can quickly access liquidity when they need it. The Fed is also looking out for emerging vulnerabilities in the financial system, such as the rise of private credit, again, like the buy now, pay later, which could be a sign of weak underwriting or excessive risk appetite. Private credit has quickly gained market share on banks in recent years. Therefore, the Fed will continue to monitor private credit's interconnectedness with the rest of the financial system. Yeah, that's an important point. Basically, credit cards, obviously credit cards are over $1 trillion, the highest amount of credit card debt we've ever had. And as credit cards have become maxed out, the savings is also at one of the lowest points that we've seen in a long time. So as savings is depleted, credit cards are maxed out. People got to go to the next thing, which is private credit or buy now, pay later. And we've seen an explosion in the use of buy now, pay later. Problem with buy now, pay later is that it's not necessarily reported on people's credit reports. So it's a little bit more difficult to monitor, so to speak. So now let's go to the next article here. It says basically credit concerns remain at bay as banks report lower than expected provisions. So, many U.S. banks reported lower provisions for credit losses than analysts expected, even as higher for longer expectations raised questions about loan performance. So of the 92 banks that disclosed first quarter earnings through April 26th, 67 posted provisions smaller than the consensus estimate, and 24 logged higher than estimated provisions, according to S&P Global Market Intelligence data. Also, of those banks, 56 booked smaller than expected net charge-offs, which is also known as NCOs, and 35 recorded higher than estimated NCOs. So credit trends have been normalizing, but there were no surprises in the first quarter. Piper Sandler analyst R. Scott Seifers said in an April 26 note covering his post-earnings thoughts on large regional banks. The analyst noted that customers have been resilient and known pressure points such as office loans are not markedly changing or creating concerns in other areas. What we are witnessing now is as good as we could hope to witness in a sustained high rate environment. Problems tied to banks' commercial real estate exposure will remain a headline risk and result in NCOs. Still, CFIRS expects reserves to stay around similar levels. Our best guess is that total NCOs will degrade only a bit. Credit loss expectations are currently manageable, though credit losses could accelerate if interest rates stay higher for longer. Yeah, absolutely. I think that is a good. I think that's a relatively good assessment on his part there. However, I think a lot of banks out there have been dealing with what you call extend and pretend. In other words, they're pushing out the maturities of these loans. They're extending the loans for 6 months, for a year, giving them some breathing room. Banks have pushed a tremendous amount of commercial real estate debt that was due, and in other words, was being rolled over. If you're following my Lords of Easy Money series, you'll understand that term, rolling the debt. For those banks out there that had to roll that debt, they've pushed it into 2024, hoping that the interest rate cuts were going to come and that was going to make refinancing the debt a little bit easier, a little bit more palatable, and thus, kind of bail them out, so to speak. Well, the extend and pretend, it can go on for a little longer. I mean, they could continue to try to push these things toward the end of the year, but the reality is, as the rate cuts continue to not materialize, the banks are going to run shorter and shorter on these time frames, and they're not going to be able to push these things out for. They're not going to be able to continue to just keep pushing these things out. So I do expect that delinquencies will rise at some point. Now, here's a very interesting thing. So I want to get back to the CECL for how banks. And how I'm trying to think of a way I can say this in a very quick and kind of simplistic way. So banks have, you could call it like 3 walls to guard against losses. Your first one, it's kind of like your first barrier. I'll call it barriers. You have your first barrier is loan loss provisions, money that you put aside for loan losses. Your second one would be net income, and your third one would be the bank's actual capital. Those are your kind of 3 layers to try to okay, these are our defenses, so to speak, against a bunch of bad loans that could potentially sink the bank. So over the years, you had issues there. Basically, in good times, when things are good, banks don't put enough money away into loan loss reserves to cover for the bad times, and then bad times hit, and banks and regulators like, oh well, you got to put more money away to cover all the loan losses now. And of course, when they do that, that hits their bottom line, and net income goes down. Bank looks like it's got poor performance because they got it kind of like it's like a domino effect. Like, you got poor performance, which causes you to put more money into loan loss reserves, which causes you to have all these headaches with loan charge-offs and foreclosures and all that stuff. And that hurts the profitability, the performance of the bank. And it just kind of, like I said, like a domino effect, because like right on down. So the idea, oh, and then you also had this thing called window dressing. Like, in other words, if a bank in a particular quarter, one of the tricks that banks use, if in a particular quarter, if banks wanted to make their earnings look a little bit better, or wanted to, in a fashion, wanted to juice their earnings a little bit, you reduce your loan loss provisions. There is now what I reported on. If you go and watch the banking update, I reported on a series of articles that basically said that net interest income for banks in the first quarter of this year was down. I mean, you were basically banks were definitely feeling some compression across the industry. And so their profitability was down a little bit. Now, they also did not take as much in most cases in provisions, in loan loss reserve provisions. They didn't put as much money aside. So if they had put, I guess one of the questions here is, if they had put the proper amount or just more money aside into loan loss provisions, that obviously would have hurt their bottom line, would have made their performance for the quarter look that much worse. So so again, there's this concept of window dressing that goes in there. So now you have CECL that comes in, and CECL basically was designed, it was going to kind of smooth that out. It was going to make sure that banks basically were always keeping a steady flow of money aside for loan losses. And it was basically going to have this philosophy of, instead of determining what the write-off was going to be and how much money you had to put aside when the loan actually went bad, you were basically going to assume that basically every loan was going to go bad at some point. And so you had to look at the life of the loan and then make a consideration based on that and then put some money aside. I think that, so one of my big questions here is if that's true, and if CECL is working the way that it should, then I don't think we should be seeing what we're just seeing here right now. And I don't think we should be having this conversation about loan loss provisions. So, I definitely want to look at, I'm going to, like I said, I will do an episode on CECL where I will get much more in depth in the explanation of CECL and how it works and why it was implemented. And, like I said, I think there are cases to be made on both sides. I think there's a lot of people out there who say, oh, CECL works great. I think there are also some people out there that would say, no, CECL doesn't work at all, and we probably just need to scrap it and go back to the drawing board. So again, a lot of I think what we're seeing here right now leads, unfortunately, to a lot more questions than answers at the moment. But so loan loss reserves, I think these were some very interesting articles here. And I think it's just something to keep an eye on for the industry, something to be aware of. Is it basically regulators feel like the loan loss provisions that were put aside in the first quarter were not quite adequate or not quite to the level of what they were looking for or wanted to see out of a lot of banks right now, particularly the larger regional banks. So we'll keep an eye on this. I mean, obviously, how this plays out over the next 6 months, over the next year, the next 18 months with delinquencies, that will determine ultimately whether or not, banks did or didn't put, enough aside to cover any potential losses that may come up. So, so again, we'll see what happens. But like I said, this is just one of those things you just kind of note, keep an eye on, put that in the back of your mind and say, okay, banks are potentially, I use that word, potentially not putting as much money into the loan loss provisions as they perhaps should right now, especially if you're a larger regional bank that has a pretty sizable commercial real estate portfolio that's filled with office and perhaps even multifamily properties. So again, I'll wrap up with this. If you like this episode, please make sure to like, share, and subscribe. That always helps the channel. You can catch us on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your questions down below. I always love getting back to everybody. Please make sure to go check out some of the other episodes on the podcast platform. And I will be back to see everybody again real soon. Thanks a lot.